Welcome back to the channel, everyone. Today I want to talk about how the volume in AMC and Gamestop is wrong. It's being divided by 10 and being covered up. I also want to talk about the new thing that's causing a hedge fund meltdown. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, the volume is wrong. GameStop reported volume has been divided by 10 since January the 8th, and this is also still applicable to AMC as well. Too long didn't read, they've been hiding GameStop's volume, dividing it by 10 this whole time. That's why we have record low volumes constantly. The volume isn't dry, it's just shy. So let me tell you what led me to even do the calculation in the first place. While looking at historical options data, I found something interesting. I noticed a pattern starting on January 8th. On January 8th, the open interest combined for all contracts was 50,614 options. 3 days later, the trading volume shot up to 144 million shares of GameStop. The pattern I noticed is that open interest or volume 3 days later on a price spike is usually roughly the same. So on January the 8th, you had a combined amount of call and put options of 50,000 options. The volume 3 days later was around 144 million shares, so the open interest over volume is 28.549. But since January the 8th, every time we've had a spike in call and put options combined and volume combined 3 days later, the open interest over volume is much, much lower. So on January the 22nd, we had a combined whopping amount of 230,000 options, but the volume 3 days later was only 93 million, even though we had more than 4 times the amount of options. That gives you an open interest over volume of only 1.716. Similar can be seen on February the 19th. Combined options were 544,000. Volume was higher, but it was only 150 million, giving you open interest over volume of 2.761. The same can be seen in March and October as well. In March, we had combined options of 296,000. Volume was only 71 million shares, giving you an open interest over volume of 2.142. October 29th, the combined volume in options was 49,000. Volume 3 days later was only 11.2 million. If you compare that back to January, we have a very similar amount of options, but volume is over 10 times lower. And the same kind of thing can also be seen in AMC as well. For the week expiring the 5th of February, back all that time ago in February, we had 53,000 of open interest options at the $7 mark. Now at the moment, we still have a lot of open interest. We've got 25,000 options at $40, 20,000 options at $41, 21,000 options at 45, and many more options as well. But we can see a stark difference in volume. For the week expiring the 5th of February, we had a day of 418 million shares traded, we had 462 million shares traded, 219 million shares, 159 million shares, and 193 million shares as well. Whereas this week, even though the options have been very, very similar, we've only had 34 million shares traded, 44 million, 82 million, and 28 million shares traded. Massive, massive lows in actual trading volume. I also wanted to thank you guys massively. You've been loving the content recently, and a lot of you have already signed up with Moomoo. Because of that, Moomoo have given me a special opportunity, and I'm one of only 4 YouTubers to receive this opportunity, all thanks to you guys. Moomoo's new massive promotion gives you 3 free stocks when you sign up and deposit at least $100. You get a free stock worth up to $350. You get a second free stock of Neo with a value of around $43, which is exclusive to my audience. And if you deposit $2,000, then you get an extra free share of General Motors with a value of around $58. And you could always sell those shares and get 3 entirely free shares of AMC just for signing up using my link below and depositing at least $100. And he says, look at open interest over volume. That's the combined open interest divided by the volume of the jump 3 to 4 days later. January 13th it's 28.5, and on average after that it's only 2 to 2.5, with some days or sometimes as low as 1.7. Since February, GameStop has not hit 100 million shares in volume once. The same thing can be said for AMC over the last few months. We haven't seen days of over 200 or 300 million shares since back in June. But yeah, it's had roughly the same open interest over volume, just like we've had the same amount of open interest on the options chain, but much lower volume. This stuck out to me as strange, and it made no sense. 100 to 150 million shares of volume was normal for a jump before March. Then it just kept acting weird. The thing that really made me wonder was how is GameStop the most trending stock on November 3rd? A magnificent run from $214 to $255 million, but yet only 11 million shares of volume. We could say the same thing for AMC. How do we run from $38 all the way to $44, the highest we've been in many months, but only trade 82 million shares? The last time we had a big run like that was back in August, here on the 24th and 25th of August, where we had 225 million shares traded and 208 million shares traded. Now, yesterday, we had 28 million shares traded, so roughly 10% of what we'd done in the past. And he says, so I look more closely at January the 8th. The only time open interest over volume was a massive 28.5. 28.5 compared to the 2.5 average is just weird. Then it hit me. What if the volume this entire time, starting after January the 8th, has been divided by 10? And if you do that, 11.25 million volume looks relatively like a normal jump to 112.58 million shares traded. You could say the same for AMC, 28.553 million, could be 288 million shares. But then he remembers how Citadel claimed to execute 7.4 billion shares on January 27th. The exact wording is Citadel securities never requested, intimidated, agreed, or otherwise sought to limit or to restrict the trading of such securities. On January 27th, we executed an astonishing 7.4 billion shares on behalf of retail investors. So therefore, if you add up all of the volume on those restricted tickers like SNDL, NAKD, AMC, BBY, BB, GameStop, and all of the others, you should get to 7.4 billion shares of volume traded. So as he kept on adding up the shares, he was inching closer and closer. 1 billion shares, 3 billion shares, 5 billion shares. At that point, he thought to himself, well, it's probably going to add up to 7.4 billion. But, hang on, it only added up to 6.67 billion shares. That means there's 728 million missing shares. GameStop's volume on January 27th was 93 million shares. If you times that by 10, you get 933 million shares, which is very close to the 7.4 billion shares that Citadel claimed. So his speculation as to why the volume is being covered up is because, for one, 100 million shares of volume plus a huge percentage gain can cause massive amounts of FOMO. And obviously they wouldn't want FOMO, which would add more and more volume, just like they couldn't handle back in January. I think when GameStop ran back in January, that's when they started suppressing GameStop's volume. But then AMC ran back in June, and I think ever since June, they've actually been suppressing AMC's volume as well. That's why we're seeing such little volume traded on a day-by-day basis. Someone's theorized that whenever they're finding two trades between the same broker in opposite directions for synthetic shares, they're not sending that volume to the dark pool anymore. They're just cancelling those trades out. Previously, that made up 90% of the trading volume, which means that the trades never reach the market. It's like voting and getting your vote cancelled by the next person that votes against you before it's counted. And he says, translating that to stocks, the volume's 10 times lower than it should be, and therefore it's taking a smaller number of shares to make a bigger change in the price. And that's why when we see AMC get ladder attacked down, it's on very little volume, but AMC somehow drops 1%, 2%, 3, 4, even 5% on tiny amounts of volume. And I also wanted to talk about hedge funds becoming the latest victims of inflation. Steve Cohen's point 72 was among those that sold stock positions just because of inflation. After slamming shoppers, manufacturers and tech giants alike, inflation is poised to claim a new set of victims, Wall Street's smartest hedge funds. Caught flat-footed by the Federal Reserve's plans to begin tapering its bond purchases, a slew of top-tier hedge firms are now coping with losses from overly optimistic bets that inflation is only a temporary phenomenon. Michael Taylor, a managing director, said nobody on Wall Street has ever seen inflation like this in their career. There hasn't been elevated and persistent inflation in the last 20 years. The market has changed since the last time we had long-spanning inflation. Most managers don't know what to do because they've got no experience in this realm and they're ill-equipped to prosper. If hedge funds like Point72 are taking on massive losses because of inflation and the surprise tapering of repurchases, this is obviously brilliant news for us apes. If hedge funds are taking on massive losses, it means they're going to be edging closer and closer and closer to being margin called and being forced to cover off all of their short positions. One institution that's quite literally been liquidated and is leaving the game is Credit Suisse. Credit Suisse takes axe to prime broking after multi-billion-dollar losses. Credit Suisse plans to all but exit the prime brokerage business that left it with $5.1 billion of losses this year. In a new strategy outlined on Thursday, Credit Suisse will consolidate its wealth management division and streamline its investment bank, including mostly exiting its prime broking unit that serves hedge funds and was at the heart of the losses incurred from the collapse of family office Archegos Capital Management. So far, Credit Suisse has only recovered $257 million from its initial $5.4 billion of losses on Archegos. And this massive loss has resulted in Credit Suisse restructuring that was unveiled at the Investors' Day on Thursday, and it failed to excite shareholders, with the bank's share price falling a whopping 5% immediately. And now I also want to touch on Adam Aron's brilliant idea to enter the popcorn selling industry. It's a multi-billion-dollar industry, and he's going to be selling popcorn at malls, home delivery or to go from theatres, and microwavable popcorn sold in supermarkets. If you didn't know, the margins on popcorn is 80 to 90%, which is absolutely massive. If you compare that to the car industry, margins suck. There's about a 5 to 7% margin on new cars before discount. So comparing that to 80 to 90% profit margin on popcorn is massive. And that's obviously going to help AMC get out of debt a lot sooner. If AMC generating massive profits on its popcorn, it's going to give them profits for the full year, getting them out of that loss reserve, meaning that they can then pay dividends. Now, there's a lot of people expressing disdain about the news to diversify into the popcorn industry because a lot of people would have preferred a full refurb on all AMC cinemas. But I think you have to understand that there's two massive different angles there. A massive refurb on all AMC cinemas would cost hundreds of millions of dollars, if not billions of dollars, and it'd dig AMC further and further and further into debt or completely deplete their cash reserves. But instead, they're diversifying into a multi-billion-dollar popcorn industry with fairly low startup costs. They already produce popcorn, so all they need to do is produce it in larger batches. That's not going to cost them hundreds of millions of dollars. It's not going to take months and months and months of refurbishing cinemas. They're literally ready to go right now. They just need to buy a few more machines to manufacture the popcorn in. So whereas one example is going to drain hundreds of millions, if not billions of dollars in cash, the other example is going to cost retrospectively nothing and is going to boost their cash by hundreds of millions and if not billions of dollars. Guys, be sure to let me know down in the comments below what you think about the volume on AMC and Gamestop being divided by 10 and being covered up. And if you haven't already, be sure to sign up to Moomoo to get those 3 free shares because at the end of the day, everybody loves free money. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.